Guys, I want to welcome you back to my channel. And in this particular video, we're going to talk about the accumulation type 1, and we're going to talk about how to trade it, and we're going to break this thing down step by step. And I'm going to give you 10 steps to ensure that you can maximize your profitability and show you exactly what to look for when you're in the market trading this type of schematic. The accumulation type 1, in my opinion, is actually one of the easiest to find and the easiest to trade, as well as the distribution type 1 as well. But like I said, in this video, we're going to talk about the accumulation. So as you guys can see with this accumulation type 1, this one here is the one that has a spring. Okay. And so that, as we can see, you have your trading range, which is this green and red line here. And things like that, and then you have your different parameters within your Wyckoff schematic. Okay, and so I'm going to break this down and show you guys a simple way on how to find this and how to trade it. Okay, so now within our steps, the very first thing we have to do is we have to find our structure. We have to understand where the market is going, because any good trader knows that regardless of the style that you're using, you always have to find market structure and understand where the market is going in order to trade it correctly. Okay. All right. So as you can see, we're on a 4-hour and we're on USD CAD, and we can see that currently we're in an up structure. Let's go ahead and notate our highs and lows. So right here we have a high, higher low, higher high, possible higher low here, which gave us another impulse to a higher high. Okay. So let's do a little bit of checks and balance. Okay. So this point here, if I put a horizontal line here, we can tell that this point is actually higher than this point. So this is a valid higher high. It broke down to a higher low, and it gave us another impulse to a higher high. Now let's look at this area here. As we can see, these points here are rather equal. Let's see, let's use this here. And so this actually makes this this equal lows. So both of these, to simplify this is our higher low area in this area here. Okay, because this is considered as a previous low, and this is a higher low because they're equal lows. Okay, now that we know that, let's kind of look and see what the market is doing. So we can see price has given us a break of structure in this area right here. Okay. So we know from previous videos, whenever we have a break of structure, one of the things we want to look for with price is for a pullback 50% or greater within our Fibonacci, and then price will continue in the intended direction in which it wants to go. I'm sorry, I messed that arrow all up. Pull back, continue in its intended direction. Okay. So in this area, like I said, so we're expecting price to give us a pullback. However, we want to see if price is going to bounce off of something or something like that. Okay. So let's look at our instructions. So number one, we found structure. Okay. Next, it says find a POI, which is considered as an imbalance or an order block. All right. So if we're looking at this and we see that price is coming down, we can clearly see in this area here, we have an imbalance that price can possibly bounce off of. Okay. So we'll notate that here. This is an imbalance. All right. So let's go ahead and play price and see exactly what it's going to do. Okay. We can see that price has tapped into this imbalance. Now, before we just, go to the next step, let's look at other time frames to see if we have a multiple time frame correlation with this imbalance. So if we drop to the 3-hour, we can see we have correlation there. Let's drop to the 2-hour, and we can see that we have a lower imbalance here. Okay, so let's play price and see if price will possibly go down closer to this area here. We can see price has broken this imbalance here. So let's go ahead and move this down to this area here. Okay. There we go. And price tapped into this imbalance here. So this one is a valid imbalance. Let's drop to another time frame to see if we have correlation. Okay. 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 So we'll go ahead and use this area here. All right. So now what did the steps say? So we want to see price tap into the previous point of interest. And the point that will tap into the previous point of interest is a spring from an accumulation or UTAD from a distribution. So in this example, we're considering looking at the spring because we're doing an accumulation. Okay, so once it taps into that point of interest, we want to look for 3 drives down and 2 drives up. Now, what do I mean by that? I'll show you guys exactly what we mean. So if we're looking at this schematic here, we notice that we have one moment, please. Let's remove this out the way. Let's move this out the way. Okay. So if we're looking at this, we notice that we have a spring, ST SAL, and we have an SC here. Okay. So when you look at these, you have 1, 2, 3 drives down. Okay. And now if we look at our AR and our UA, so we have 3 drives down and 2 drives up. Okay, so that's what the steps say. We want to look for 3 drives down and 2 drives up. Okay, let's go ahead and remove this and remove these here. All right, so what we want to do though, we want to drop to a smaller time frame to see if we can see that, because on this particular 2 hour we don't necessarily see that. So let's drop down to the 1 hour. No, not necessarily. We don't really see that. Let's drop to the 30-minute. Okay, we can start to see a little bit of peaks and valleys on this particular time frame. So let's see. So from here, we have 1, we have 2, and we can see we do have 3 drives down. And let's see if we have 2 drives up. So we have a drive here, and we can see we have a drive there. So we satisfied at 3 drives down and 2 drives up. Okay. Now, to mark this up, the easiest way that I can actually explain this to you guys is we want to start from right to left. Okay. So now we want to start with the furthest point, which is your spring. And I'll put a number 1 here because this is the first point that we want to mark up as our spring. Our ST is SAL. Oh, sorry. Which will be number 2 that we'll mark up and find. Next will be our SC, which will be number 3. The next one will be number 4, which will be our AR, which is our automatic rally, automatic reaction, whichever one you want to call it. And this point here would be our UA, which will be point number 5. Okay. And then of course we have all the other points as well, which would be your PS here. And then in this area here, you might have something that is called a jack or something like that. Okay. But the main points to actually find the schematic would be these 5 points here. And you want to label them from, pretty much like right to left. Spring being number 1, ST SAL 2, 3, 4, and 5. Now, once you find all of these points here, one of the things that you can do is you can start to find your trading range. And your trading range is between your SC and your AR. Okay? This is your trading range. Now, within this trading range, it can either be aligned with your wicks or your bodies. And I'll explain that once we get to the other steps. Okay? So now, as you guys can see, we have our Wyckoff present. Now, what do the steps say? Let's check the steps out. Here we go right here. So now it says, once we find our 3 drives down and 2 drives up, we need a break of structure, which breaks our UA. Okay. So here's our UA here. This should be a break of structure. Okay. So let's look at the market right now. Let's look at market structure. So if we're marking this up, we can see we have a lower low, lower high, lower low, lower high, lower low. Looks like we have a break of structure here. However, we got another impulse to another low because we can see this low is lower than this one. Because we know that, now we can mark it up as such. Lower low, lower high, lower low. All of this in between is considered as noise. Okay, so that's the noise. So here's our actual market structure. Lower high, lower low, lower low, lower high, lower low. And as we can see, we got a break of structure here. Now, whenever you have a break of structure, we want to utilize our Fibonacci tool from the swing high to the swing low. And we want to look for a pullback 50% or greater before price. Let's see. We want to look for a pullback 50% or greater before price goes in its intended direction. Okay, so everything from the 50% on down to this area is all premium pricing, and this is where we want to look for entries in this area here. Okay, so let's remove this and that. All right, let's look at our rules. Next, it says after your break of structure, we want to look for trading range alignment. So what does that mean? So now, when we were marking up our trading range, you guys, I said you can utilize the wicks or the body. And so as we can see in this area here, we have this huge imbalance. We have this imbalance, and we can see that price has rapidly raced away from our spring. Okay, so we have an imbalance right here. And now, because we see that this is close to our trading range, we can move this up to the body here. And as we notice, this aligns perfectly with this imbalance. This is considered as trading range alignment. Now, when you have trading range alignment, this serves for high probability trades. Okay? So that's what we want to look for. Now, trading range alignment is not a requirement, it's a confluence. But a lot of times when we have trading range alignment, we definitely want to look to that for our entries. Okay. So now that we move this to our bodies, we want to move this one as well because we want to be consistent in how we mark up our schematics. Okay. Now, when we're looking for entries, we want to look for entries off of either the trading range from the AR or the SC. But as we can see from the AR perspective, there's nothing or any confluences that will persuade us to trade from the AR's trading range. So this one is aligned perfectly. So this is the one that we'll look at. Okay. So now, what does the rule say? If you have trading range alignment, you want to make sure that you have unhealthy price action. Now, what is unhealthy price action? If I drop to a smaller time frame, you would notice that this big green candle that we had here, it has all of these huge candles with imbalances and things like that. When you have multiple candles like this with huge price action, this is considered as unhealthy price action because you have all of these unfulfilled orders. You have imbalances that price needs to come back to actually take out. Now, one of you guys, I know you're noticing that we have an imbalance all the way down here, and some might ask the question, well, why wouldn't you choose this area here for your entry? Because like I said, we want to look for entries that aligns with our trading range. These serve for high probability trades. A normal person will look and say, well, price is going to touch this point here, but because we have trading range alignment and it aligns perfectly here with our 30-minute, that's the area in which we want to utilize for our entries. Okay. So now it says our entry, we need to align it with our TRA, with our trading range, if possible. So now what we want to do we want to take our long tool and we want to align it here. Okay. Now, as far as our stop losses, we want to utilize either the body or the wicks. And preferably, we want to, whenever we're taking Wyckoff trades, I like to stay within the parameters of 10 pips. I don't like to go anything more than 10 pips. And I feel like if it's more than 10 pips, then that trade is invalid, because you don't necessarily need to take any Wyckoff trades with more than 10 pips. Okay. So as we can see, this particular SL is about 7.4 pips. Now, when we're looking for exits, we want to look for the nearest equal highs or points that align with that. Okay. Now, when we're choosing our TPs, I like to stay anywhere within a 1 to 6 or a 1 to 10. Okay. So if I move this up, this area here, as you can see, which aligns with this price action here, as these these bodies here touch. Right now, this is a 1 to 8 point. This is a 1 to 8 to 8.2 type of risk to reward, things like that. Okay. Like I said, I like to stay between a 1 to 6 to 1 to 8. So in this example, I'll just utilize this area here for my targeted TP. Okay. As you can see, I've chosen this area here. These are like equal highs because these two bodies align. So I utilize this target here, and we utilize up under this wick here as our stop loss. Okay. This is our SL. Now, let's go ahead and play price action, and let's actually see how this plays out. Let's go ahead and move this imbalance over here, and let's go ahead and play price. As you can see, price is going up, catching his feet. Wicks us in right there, aligns with our entry. We'll move this over here, and we can see price is starting to rapidly go up. Let's move this down so we can see exactly what's going to happen. As you see, right to our entry. Okay. Now let's go ahead and recap. So like I said, you guys, when you're looking for Wyckoff, first thing you need to understand is you need to find your structure. Where's the market going? We understood that with this particular trade, we had a break of structure, so we're due for a pullback, and so we needed, price needed to tap into a point of interest, which is an imbalance or order block. We can see price tapped into this order block. This imbalance, and then from there we would drop down to a smaller time frame to look and see if we saw 3 drives down and 2 drives up. Okay, we wanted to make sure that we had a break of structure, which broke our UA. Let's go ahead and break it down to a smaller time frame so we can see that. Make sure we have everything that's aligned. We had a break of structure that broke our UA. From there, we wanted to look for trading range alignment, which we had in this area here. It was perfectly aligned. Next, from there, we need unhealthy price action. That's important. A lot of people, they try to omit number 7, but we need unhealthy price action in this area, you guys. So once you find your UPA, you want to set your entry along with your trading range. And then from there, you want to set your exits next to the nearest equal highs, which I like to say either a 1 to 6 or a 1 to 10. 1 to 6 through a 1 to 10. That's what we want to look at as far as our risk to reward. Okay. From there, you can set an alert somewhere in this area when price is approaching your entry. And then when you're setting this type of entry, for those who don't understand how to set pending orders, this is considered as a buy limit. Let me notate that. A buy limit. And basically what a buy limit does is you can go into your MT4, MT5, whatever one you use or whatever broker you use or platform, and you can set a pending order to say, when price gets down to this point here, to this entry, to activate my trade, and then price will go into its intended direction. Okay, so a buy limit is when you want price to come down to a certain price. You want the market to come down to a certain price, hit that price, and then go away from it in the opposite direction. So that's considered as a buy limit. Okay, so you can go and set your pending orders for price to come down, wick you in, take you out, and you're golden. Hey, you guys, I want to thank you for rocking with me on this video. I hope this was informative for you. As always, I appreciate you, and I'll see you guys on the next video.